This year, my wife and I made just over $1 million of income, and let me walk you through how we are not going to pay $1 of income tax. Here we go. The saying by Robert Kiyosaki, "It's not how much you earn, it's how much you keep," is dictated all about how you earn your income. If you check out the book Tax-Free Wealth by a guy named Tom Wheelwright, who actually is Robert Kiyosaki's accountant, what you'll discover in that book is the tax law, the IRS tax code, is actually not out to get you. The government's actually not out to get you at all. It's a list of incentives, meaning that when you go and start businesses, when you invest in oil and gas, when you purchase real estate and you do these things, what you're doing is you're stirring on economic activity, which is what the government wants. So what they do is they use the tax code as incentives for you to do those certain things to create more jobs and economic output. And in chapter 7 of that book, he goes over this idea called depreciation. And on paper, depreciation sounds like a bad thing. It sounds like something's losing value. But in real estate investment, actually, it's a great phantom expense. Those are the language and vocabulary that he uses. And what you're able to do essentially is take a dollar for dollar deduction against your income of the investment real estate passive income that you earn. So meaning, let's say that you go purchase $1 million building. In commercial real estate, you can deduct about $25,000 a year. It's called straight line depreciation. And over 39 years, you divide $1 million or whatever your purchase price is by 39. In that case, it's like 24 grand. And you can take a dollar for dollar deduction against the income of that property. So let's say you buy $1 million building and it threw off $25,000 of passive income that year. You made 25 grand, but the passive or the depreciation deduction is a passive loss of $25,000. So what happens is that income and that loss offset, and you don't pay any taxes on any of the income of that investment. But you might be thinking the same thing. Well, Nolan, I don't have the ability to buy $1 million building right now. I'm just a W-2er or a 1099er. How can I go and take these passive losses like depreciation against my earned income? Well, in 2016, when President Trump passed the Jobs and Tax Cut Act, what he introduced was this idea called bonus depreciation in real estate professional status, which is really cool. Let me explain this to you. So a real estate professional is somebody, it's a pretty broad term. Candle, you can look it up, you can talk to your accountant about it. But essentially what it means is that you spend over half of your time in real estate and over 750 hours a year in real estate as an investor or a realtor, somebody doing something in real estate, okay? And so what that does, what this status does, it's a box that you check on your tax return, is it essentially allows you to begin taking passive losses, like I just mentioned to go on that $25,000 of loss. You can start taking those losses against your active income, okay? So think about it this way. Now that let's say you had a $25,000 loss because of the depreciation, and you had $100,000 of income at your W-2. Well, now, just like a mortgage interest deduction that you get to take, or your general deductions, you get to now deduct $25,000 against your earned income if you are a real estate professional. So let's take it a step further. Like I said, in 2016, when that Jobs and Tax Cut Act was passed, bonus depreciation showed up on the scene. And what that allows you to do, without getting really in the weeds, you can do what's called a cost segregation study. And simply what that means is that there's objects and things inside of a building that are not attached to the structure of the roof. And what you can do is you can group these items together, figure out what their depreciable lifestyle or lifespan is, front load that cost into the very first year, and then take that depreciation all in the very first year of that purchase. So like I said before, on $1 million purchase, before on a straight line depreciation, it would be $25,000. Well, with bonus depreciation, you can take closer to $200,000 on that same exact purchase. Okay, so to come full circle, easy example, you buy $1 million building, you do a cost segregation study, you take bonus depreciation, you now have a $200,000 passive loss. You or your spouse can become a real estate professional. Again, talk to your accountant about how you can get that. It's not that difficult. But you may, let's say you're an engineer, you made $200,000 this year, and your employer every year is withholding $80,000 for taxes, income tax. Well, now you earned 200 grand, you lost 200 grand. You can now take this passive loss against your active income. They wipe out, And then that $80,000 gets refunded back to you at the end of the year, and you pay no income tax. So how my wife and I are able to not pay a dime of income tax on the $1 million that we earned this year was we purchased just over $5 million of real estate. And what that means is we took bonus depreciation. We did cost segregation studies on every one of our buildings, and we had a passive loss of just over $1.1 million. So it completely wipes out any potential income tax opportunity, and any extra passive loss, we're able to carry that forward into the next year. So to sum it all up, my best recommendation is read the book Tax-Free Wealth by Tom Wheelwright. It truly changed my perspective. Before, I was thinking Uncle Sam was out to get me. I look at my 2-week check and I'd see all those taxes getting taken out, and I was upset about it. But then once I discovered that the tax law is all about incentive, doing things the government is wanting us to do, therefore we'll get subsidies and deductions, that's when I changed my mindset and started focusing on using the tax laws to my advantage. Because at the end of the day, it's not about how much you earn, it's how much you keep. And if you're still here, that means you're probably an investor, you're a parent, a grandparent, somebody that has some liquidity or any type of investment appetite. You know, when I first got started, my biggest mistake that I made was wanting to not only invest, but thinking I could do it all by myself. So don't invest alone, because that's the worst decision that you can possibly make. What you can do though, is if you click my profile link, watch the video there. And if it has anything to do with our appetite that you have for investment in partnership with me, book a call directly with my team and I, and we can see if we have the right fit and compatibility for us to move forward together and purchase these commercial real estate deals and take these massive deductions against our income the same way that my wife and I are. If that has any correlation to what you like to do, book a call with me and I will see you on the other side.